Are you curious about what institutions are looking for when reviewing your application for a mortgage? And what can actually affect your mortgage application? As part of the qualification process for a mortgage, lenders tend to use two main ratios to decide if you can afford to buy a home and what the value of that home is. Those ratios are GDS and TDS. GDS stands for Gross Debt Service Ratio. It is the percentage of the borrower's income that is needed to make all payments associated with housing, such as heating, mortgage payments, property tax, and others. There is a maximum amount associated with this ratio to ensure that borrowers can afford to carry the debt. It does vary depending on the institution, and usually it must not exceed 35%. TDS, or Total Debt Service Ratio, is the second ratio used to calculate affordability of a mortgage. This ratio is calculated as the percentage of annual income required to cover housing costs, also known as GDS, plus any other loan and credit card payments that you may have. It can include, again, credit cards and car payments. There is a maximum amount associated with this ratio to ensure that the borrower can afford to carry the additional debt. Most lenders recommend a TDS ratio of no more than 42% for mortgage lending. Sounds complicated? Well, for all of my mathematicians out there, it is a simple formula. GDS is calculated by adding principal plus heat plus interest plus tax and dividing that figure by gross annual income. Convert this figure into a percentage, and if you are at 35 or below, then it is a desirable ratio for lenders. TDS is calculated by adding principal plus interest plus taxes plus heating and other debt obligations, dividing this again by your gross annual income. The magic percentile here is a figure under 42%. Contact me if you still have any questions. Here at GMS Mortgages, we want to make sure that you have all of the information you need to make the right decisions.